Hey everyone, welcome back to Corporate Decoder. Today JRSH just filed their annual report for 2026 and I am seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is reporting a nice jump in sales, but their efficiency might be hiding a bigger problem. This is an annual report for Jerash Holdings Us Incorporated. They are in the business of making clothes, specifically sportswear and outerwear, and they export a lot of it from Jordan. Think brands you might know like the North Face, Timberland, and Vans, which are owned by VF Corporation. They also sell to New Balance and Hugo Boss, among others. This report covers their fiscal year that ended on the 31st of March 2026. So the numbers we are looking at are for that whole year. First off, let's talk about revenue. Jerash Holdings brought in about $166 million in revenue for fiscal year 2026. That is a pretty good jump, about 14% higher than the $145 million they made in fiscal year 2025. They say this increase is thanks to new customers like Hansel Group and more business from companies they already worked with like Acushnet and Thoranko. Now, who is buying from them? VF Corporation, the big apparel company, still accounts for a huge chunk of their business. In 2026, VF Corporation made up over 52% of their sales. That is down from almost 65% in 2025, which is good diversification, but still a very heavy reliance on one customer. New Balance is their next biggest customer, at almost 14% in 2026. Looking at where the money comes from geographically, the United States is still their biggest market, bringing in 83% of their revenue. That is down slightly from 88% in 2025. Interestingly, sales to China and Hong Kong more than doubled, jumping from about $9 million to nearly $17 million. This is driven by new customers like Hansel. Now for the part that makes me pause, their cost of goods sold, meaning how much it costs them to make these clothes, went up to about $139 million in 2026 from $123 million in 2025. That is an increase of 13%. Here is the kicker. Even though their cost went up, their gross profit margin actually improved slightly. It went from 15% in 2025 to 16% in 2026. They attribute this to better efficiency through automation and getting more out of their factories. This sounds good on the surface, but when costs for materials or labor go up, and a company can offset it with efficiency gains to maintain or slightly improve their gross margin, it can sometimes hide underlying pressures. It means they are working harder to maintain that margin. Their selling, general, and administrative expenses, which are things like marketing, office staff, and logistics, actually went down slightly to about $20.5 million from $20.9 million. They say this is due to better control of export logistics and lower stock-based payment expenses. All of this led to a net income of $3.6 million in 2026, which is a huge turnaround from a net loss of $840,000 in 2025. They also saw a significant reduction in their effective tax rate. Let's look at their cash flow. As of the 31st of March 2026, they had about $10.8 million in cash and cash equivalents. That is down from about $13.3 million at the same time in 2025. They used more cash this year mainly because they bought a new factory premises in Jordan for about $3.6 million. Their net cash from operations was about $2.5 million in 2026, up from $1.4 million in 2025. This is good news, showing they are generating more cash from their day-to-day business. But remember that factory purchase. Investing activities show a big jump in cash used, going from about $2.4 million in 2025 to almost $5.8 million in 2026. This is directly linked to that property acquisition. Now, let's look at the risks, and Jerash Holdings has plenty of them. Their biggest risk, as we've seen in the numbers, is their reliance on a few key customers, especially VF Corporation. They don't have long-term contracts, so if VF Corporation decides to buy less, it could seriously hurt Jerash's sales and profits. They also operate heavily out of Jordan, which brings its own set of challenges. Social and political uncertainties, military actions, and even things like the recent conflicts in the Middle East and Red Sea shipping disruptions can impact their business supply chains and costs. They mention increased logistics costs due to the Red Sea attacks, and military conflict involving Iran and Israel impacting global markets and potentially Jordan's economy. And of course, there is the constant threat of not meeting Nasdaq's listing standards. If that happens, their stock could be delisted, which is never good for shareholders. Looking at their balance sheet, total assets grew to about $89.8 million in 2026, up from $83 million in 2025. This is driven by increases in property, plant, and equipment, and also inventories. Current liabilities, which are the debts they owe in the short term, rose to about $21.6 million from $19.8 million. This is mainly due to an increase in accounts payable and accrued expenses. Shareholders' equity also saw growth, reaching about $64.9 million in 2026, up from $62.8 million in 2025. This increase is thanks to retained earnings, which is the profit they've kept in the business. Going back to the income statement, they reported a profit attributable to common stockholders of $3.5 million in 2026, a massive swing from a loss of $848,000 in 2025. This translates to basic earnings per S-share of 28 cents in 2026 compared to a loss of 7 cents per S-share in 2025. Diluted earnings per S-share also show a positive shift. One thing to note is that stock-based compensation expenses were lower in 2026 at $904,000 compared to $1.7 million in 2025. This helped boost their net income. However, a large portion of their restricted stock units, or RSUs, were granted in March 2024 with a 3-year vesting period. So we will likely see these expenses increase again in future years. The auditors, CBs, CPAs, PC, gave a clean opinion on their financial statements. They noted no critical audit matters. They've been the company's auditor since 2016. An important point here is about their internal controls. In fiscal year 2024, they found that their internal controls over financial reporting were not effective, specifically in managing user access to their IT systems. However, they implemented corrective actions, and for fiscal year 2026, management concluded that their internal controls were effective. This is a positive development, showing they addressed a significant weakness. Looking at their subsidiaries, it is clear they have a complex structure with operations in Jordan, Hong Kong, and China. This international presence brings both advantages in terms of cost, but also risks related to different regulatory environments and geopolitical factors. So, what is the story here? Jerash Holdings had a strong year in terms of revenue growth and a significant turnaround in profitability, largely driven by new customers and better manufacturing efficiency, which helped them navigate rising costs. However, their heavy reliance on VF Corporation and the inherent risks of operating in Jordan remain significant concerns. The improvement in their internal controls is a welcome positive sign. My biggest concern is the sustainability of their efficiency gains, while they've managed to improve gross margins despite rising costs. It is a constant balancing act. The other major risk is still that customer concentration. Losing VF Corporation would be devastating. What I am actually looking for is continued diversification of their customer base and evidence that their efficiency improvements are sustainable beyond just cost control. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found value in this analysis, please like and subscribe. More deep dives are coming your way, and join our Discord community for more direct analysis.